Okay, everyone. I'm Jason Hamilton with Stockyards Wealth Management Group. Welcome, everyone, for joining today's call. Wanted to, first, a little housekeeping. Everyone should be on mute, but just be mindful of that. Make sure you stay on mute if you're going about other things as you listen to today's call. Questions, you can chat if you're on the computer, questions into me throughout the call today. Bottom right-hand corner, you should have a little chat text box that'll pop up when you click on it. Shoot those my way. If you're on a phone, I believe *6 will unmute yourself at the end, and we'll take questions at the end for those of you that want to ask questions. Appreciate everyone being on board today. I have the easy part of the call, just to make the introduction. I hope that we captured some of your attentions with it's March Madness, and then you were probably let down to find out that it wasn't a bracket coming to you or something related to basketball, but it was to talk about the current environment out there within the economy and really in the bank environment and financial world. So today I'm going to be turning it over to John Fidler. He's our Chief Investment Officer. For those of you that maybe haven't met him, or have only had the pleasure of catching up with him on a short period of time, quick reintroduction for John. He came to us with the merger of Commonwealth Bank and Trust almost a year ago now or so. And in the fall, this past fall, was named our Chief Investment Officer. So John carries a track record of 20 plus years in the financial business. He's a Washington and Lee grad. Spent some time in the hedge fund world. Got acclimated there, spent a lot of time with a private investment office for 10 plus years or so as a portfolio manager overseeing various portfolios for families and institutional clients. Led Commonwealth's alternative strategy team and just brings a lot of knowledge and resources of what's happening out there, not only just regionally but globally. And his team that came with them from Commonwealth, have greatly helped us out as far as Stockyards Bank being a bigger and better investment team, much even more dynamic than we were, and helped bring our assets up to close to $7 billion in assets. And that's up or down any given day these days with where the market's going. So with that, John, I'm going to turn it over to you, and we'll allow for questions at the end.
Thanks, Jason. Can you hear me okay?
I can. Yep, you're good.
Okay, great. All right. So, yeah, like Jason said, just in time for March Madness, we've had some craziness in the markets here, particularly over the last week or so. And, really just want to talk at a high level here today about, the current market environment, what's going on with interest rates and how that's impacting, the economy broadly and specifically the financial sector. We've seen some, what we think are pretty idiosyncratic problems with a couple banks that were heavily focused in cryptocurrency, and then one bank that is heavily invested in startup companies, and talk really about how those three banks, and particularly Silicon Valley Bank, are fundamentally different business models from the typical regional bank model, and why we don't believe there's sort of contagion risk here to the broader banking sector. Compare kind of how a typical bank manages their balance sheet relative to the way Silicon Valley Bank was managing their balance sheet, but then talk about where we go from here and what some of the knock-on macro effects from these events are. So just for a starting point, broad backdrop, obviously last year was a difficult year for most asset classes, bear market in all major stock and bond asset classes. This year we've had a bit of a bounce, although we're giving some back this month, obviously. And a lot of talk about this being a new bull market and that type of thing. Our view is a little more cautious. We think this is probably more of a bear market rally, and we'll talk at the end about positioning around that and how we've been positioned and will continue to be in a way that has benefited our clients and we think will continue to. So in terms of the macro backdrop, a lot of things I think we all know, but just to quantify them in charts here, the Fed has hiked short-term rates from basically 0 not basically zero, from zero at the beginning of 2022 to almost 5% today. So that's the fastest pace ever. They're very focused on trying to break the back of inflation, which continues to run hot, as we saw yesterday with 6% year-on-year CPI print. Financial conditions, that's that red chart. This is a financial conditions index that Goldman Sachs creates. It's basically an index that looks at credit spreads, interest rates, volatility of markets, a variety of gauges of sort of lending standards, a variety of gauges of sort of tightness or looseness in the financial markets. So this chart goes back 2 years. So you can see in 2021, conditions were very loose and they've tightened significantly. And then kind of a corollary to that is the yield curve, historically an inverted yield curve, meaning short rates above long rates, has been an indicator of a recession 6 to 24 months in the future. And despite some reversion to the mean here over the last couple of weeks, as people have piled into bonds as a flight to safety trade, yield curve remains very inverted. And that's very important for understanding what happened to a group like Silicon Valley Bank, because the sell-off in bonds and the inversion in the yield curve is part of what created a problem for them. And we'll talk about how they managed or didn't manage that risk relative to how a typical regional bank, including Stockyards, manages their balance sheet. In the face of all that, sort of financial market stress, tight financial conditions, financial markets, Wall Street signaling recession, we've seen the economy remain relatively resilient. Growth is still positive, even net of the high inflation rate, and we believe it'll continue to be at least through the end of this quarter. And inflation remains relatively high. Probably we think above 5% at this moment. It was at 6% in January. And you can see there on the right, estimates of real growth. The median estimate is about 0.5% GDP growth for the first quarter. But some of the more high frequency, what they call nowcast, real-time data that the Atlanta Fed generates would tell you that we might actually be quite a bit higher than that, closer to 2%. So, sort of the real economy, Main Street, remains a lot more resilient than those financial market metrics would imply. So let's talk a little bit now with that backdrop about, the banking system and how banks work, right? So when I came into the financial industry 25 years ago, and I'd done, financial statement analysis in college and grad school, banks' balance sheets are kind of inverted from every other company's balance sheets, right? You would think if someone gives you money and you hold it, well, that's an asset, but that's not how bank accounting is done. A bank, their liabilities are their deposits that depositors give to us every day. And then banks, take those deposits and they either make loans or they buy bonds. And inherently, you have demand deposits that could be taken back tomorrow. So you're effectively borrowing short and you're lending at some longer duration than that. It might be 6 months, it might be a year, or in the case of Silicon Valley Bank, you might be buying 30-year mortgage-backed securities. But you're going to take those short duration assets and put them into some other typically longer dated asset. So this chart shows kind of how the average U.S. regional bank deploys those deposits. They typically have about half of those deposits in loans and about 20% in securities, so bonds, and about 15% in, totally liquid cash. And this percentage roughly, equates to, you can look at Stockyards 10K and see that it's pretty similar. We have about 20% in securities and over 50% in loans. And, the spread on that, what they're paying in deposits versus what they're making on loans and securities, that's the profit margin, the net interest margin of a bank. And so inherently, there's an exercise here where you have to manage risk, you have to match duration, you have to decide how much of those securities that you buy are going to go into a hold to maturity bucket versus an available for sale bucket. You have to make sure that your deposits are sufficiently diversified and that you have sticky relationships with those depositors. And those were all things that were not the case with Silicon Valley Bank. How did they manage their balance sheet? You can see they were very much an outlier relative to other large banks. And why is this? Why did they have over 50% of their assets in securities instead of making loans? Well, their business model, as the name might imply, based in Silicon Valley, they almost exclusively provide loan and deposit services to startup tech and healthcare companies and the venture capital firms that serve them. And those assets ballooned. They had their deposit base about triple over the last 3 years, making them the 16th largest bank by assets in the U.S. So as all this money was raised over the last 1 to 10 years for tech startups by the venture industry, investors wrote checks to those venture capital funds. Those venture capital funds deployed money to startups. Those startup tech companies don't have debt. They don't have lending relationships. They have equity. So they would take that cash and park it at Silicon Valley Bank to, run payroll and manage their businesses. So they had enormous deposit growth, which is a good thing. But because they didn't service businesses that had lending needs, they didn't make a lot of loans. So they plowed those investments, plowed that cash into the bond market. And that in and of itself isn't necessarily a bad thing. But the problem is they invested in a lot of mortgage-backed securities, treasury bonds, municipal securities that were relatively long in duration. So they were taking all these deposits that were coming in and they're plowing them into 30-year mortgage-backed securities yielding 1%. So as that yield curve inverted and their funding costs on deposits went up and they had losses in their hold-to-maturity portfolio, they had a duration mismatch that was a problem. And then because they had this high concentration of large depositors in the tech space, we all know that tech has been under pressure for the last year. There hasn't been much new funding in that space. Those companies have cash burn typically. They're not free cash flow positive. So they're drawing down securities. They're drawing down deposits. And then you had the venture industry kind of last week turn around and say, well, we think the situation's, untenable. And they told their portfolio companies, you should pull your cash. And because of this, really high funding concentration in the startup and healthcare space, and those deposits being controlled pretty much entirely by venture capital companies that worked with Silicon Valley Bank, both directly and indirectly through the customer base they controlled, a very few number of people in Silicon Valley have the ability to trigger basically a run on the bank. On the deposit side, the typical bank, like Stockyards or most regional banks, 40, 50%-ish of their assets of their deposits will fall under the FDIC's $250,000 per depositor insurance cap. That was not the case at Silicon Valley. 95% of their depositors were uninsured. And this was sort of the primary cause of the panic that exacerbated the situation. And I think, luckily for stemming any, contagion risk, you had the FDIC and the Treasury and the Fed step in over the weekend and make depositors whole. So big picture, Silicon Valley Bank took a wave of deposits much higher than the industry in terms of percentage growth. Their deposit base about tripled versus about a 35-40% increase over the same period the last 3 years for the banking industry in general. And that's all fine. But then they piled into 10-year and longer bonds, and they stuck with them without hedging at very low yields. So something that the traditional banks do not do. Traditional banks like Stockyards would have the majority of their deposits fall under the existing FDIC limits. They would have relatively short duration on their earning assets. They would have ample sources of off-balance sheet liquidity through the Federal Home Loan Bank, which Silicon Valley Bank had already tapped actually back in the fall. So a lot of factors around Silicon Valley Bank that are unique really in the banking industry. So as of right now, this issue is a non-issue for most regional banks, and certainly a non-issue for stockyards. But there are knock-on effects for the banking system. I believe we'll continue to see a higher cost of capital as interest rates go higher. We're likely to see additional regulation. Silicon Valley Bank grew very quickly, and they fell outside of the SIFI, strategically important banks that are stress tested on a regular basis. So I think you're going to see more regulation on regional banks, even those that are properly managing their risk. I suspect you'll see an expansion of the FDIC deposit program. They haven't explicitly said that. The facility over the weekend allows banks to repo assets at par in order to meet deposit outflows, but it doesn't explicitly increase the insurance cap or explicitly guarantee deposits at other banks. But I think we could see that. Broadly, I think it's going to be another factor that leads to a slowdown in loan growth generally. What the market is extrapolating from this is that this is a stress factor that's going to cause the Fed to end their tightening cycle early. And so this is a chart here that shows kind of what was priced into the fixed income markets over the last few days. And I know this is hard to see, it's kind of small, but it's basically saying that as of, the evening of March 10th, so last Friday, the market believed that, as of September, Fed funds rate was going to be around 5.25. As of March 13th, Monday at 8 a.m., at that same point in time, the market's pricing about a 4.4% Fed funds rate. So actually implying that between now and the fourth quarter, the Fed's actually going to net cut rates. So quite a bit changed in a couple days. Thursday, the market was pricing in a 70% chance of a half-point rate hike in March. If you go back just a week ago, Fed Chairman Powell was kind of hinting that they might need to do that. Today, the market's pricing in a 50% chance that they won't hike at all. And I think we'd be a little skeptical of that. I think they're going to hike 25 basis points. We did have a somewhat deflationary event with this bank failure, and like I said, I do think it'll lead to a downtick in loan growth, which leads to a tightening of financial conditions, which kind of does the Fed's work for them. But I do think the vast majority of banks don't have issues. The new Fed facility, effectively guarantees a lot of deposits and allows banks to underwater to repo, underwater securities or securities that they have a loss on at par. So I think that systemic risk has largely been attenuated. We'll see. There's certainly other risks out there. Just today you have Credit Suisse is in trouble again. It seems like the European banks are in trouble annually, if not more often. But particularly given how hot inflation continues to run and how low unemployment is, I'm not of the view that this really derails the Fed's rate hike path over the next few quarters at least. So our view continues to be that the Fed's going to remain restrictive, and whether that means they hike one more time or three more times or even no more times, policy remains restrictive, as we saw in that financial conditions slide. Consumers, though, still have quite a bit of excess savings left over from COVID. We've seen credit card balances tick up, but debt service is still kind of at historically normal levels. Companies are still planning to spend on CapEx and hiring in 2023. Things like layoffs at Facebook or Goldman Sachs make big headlines, but if we look at the economy as a whole, particularly in our region, we still see a tight labor market. So we think there is likely to be kind of a garden variety recession, not a 2008 scenario, not even a 2001 scenario. Last year we had what we called a rhino recession in name only, when we had those two consecutive prints of negative GDP growth. And I think if we do get a more proper recession second half of this year, it's likely to be relatively short and relatively shallow because companies, consumers, and the banking system, would be going into that recession in sort of the strongest shape they've ever been in. We do think inflation is going to remain pretty sticky. It's really hard to get headline inflation below about 4% by the middle of this year, before the middle of this year, which is still double the Fed's target. And so we think inflation's likely to stay in that sort of 3 to 4% for maybe longer than the Fed would like, and that's going to be contributed to by the reopening in China, coming out of their zero COVID policy and seeing growth ramp up there. And more structural factors, just kind of continued deglobalization as we see more onshoring, more just-in-case inventory instead of just-in-time inventory, shoring up of supply chains. All that stuff leads to economic resilience, but it's also structurally inflationary. So maybe a higher floor for inflation than we saw sort of pre-COVID. And so, this is a slide we've been showing for a while. I think the big lesson of Silicon Valley Bank, who, in our view, sort of what happened to them was largely self-inflicted. They made a dumb one-way bet that rates would stay indefinitely low, and we've seen this cause problems elsewhere. Britain had sort of a pension crisis erupt last fall because of folks who made similar assumptions. And so I think the big investment lesson is we need to think seriously about a world where rates stay higher for longer than anyone thinks. And, we've been thinking about this and talking about this for over a year. And it leads to the need to be more diversified at the asset class level, to focus on, quality, super high quality companies with robust balance sheets and cash flows, stay relatively short duration in the fixed income space, but be tactical. And if we see, 4% plus 10-year yields again, that presents some value, and that presents an ability to hedge against a potential hard landing, by having bond positions that would benefit from a sudden decrease in growth or a sudden about face by the Fed. But then on the other side of the spectrum, looking at things like commodities, commodity companies, diversifying alternatives, other things that are going to hedge against deflation. So we talk about these two acronyms in the sort of period before and right after COVID. The acronym that people bandied about was TINA. There is no alternative, meaning there's no alternative to the equity markets. You get no yield in bonds. Money markets are yielding zero. Commodities are doing nothing. Hedge funds aren't performing. You just need to be in the stock market. There's no alternative. Last year, this year, and going forward, we think the more relevant acronym is TARA. There are reasonable alternatives. The things we just spoke about. You are getting better yields in fixed income. You're getting a lot better yields just in cash. Money markets yielding close to 4.5% and likely to go higher. You do have commodity markets that are performing well. You had diversifying alternative strategies perform really well last year. So more tools in the toolbox that are working right now for portfolios in order to diversify and protect against deflationary events like what we just saw in the banking system, and against potentially higher for longer inflation. So those are kind of my main talking points, but I'm happy to take some questions here if you want to put them in the chat, or if you want to unmute, or if you want to just email us at this email address. We'll get back to you, or give me or Jason a call, or whoever your account coverage is. We're happy to speak with you more in depth on any of these issues, but wanted to keep it fairly high level and be respectful of everybody's time this morning.
John. So with that, everyone, as John said, if you have a question, you can chat it in or unmute yourself on your phone line and or computer. Happy to address any questions that you have. John, who's your pick in the real March Madness? You have one?
I took Alabama. We'll see. I think UCLA could be tough too.
Okay. Well, I'm not seeing any questions, so we'll probably let everyone go. As mentioned earlier, you can always email us, wmtquestions@syb.com, and we'd be happy to get back to you if something should pop up afterthought. Otherwise, be on the lookout for any future communication, and we hope you enjoy a great St. Patrick's Day. Thanks for being a great customer of the bank, and enjoy the rest of your day, folks. Take care. Bye.